Dear friends, in this video, I'm going to share with you my investment journey as a junior doctor in India and the three most important financial lessons of my life. Hello and welcome to my channel. If you are new to my channel, then my name is Suman and I work as a doctor in UK. In this channel, I share my journey as a doctor from India to UK and various aspects of my life in UK. I have already posted videos about PLAB and MRCP examination, internal medicine training in UK and respiratory medicine pathway in UK. Let me start off with a story today about how Max Planck, the famous physicist, after he won the Nobel Prize, went around Germany giving the same stand-up lecture on the new theory of quantum mechanics. Over time, his chauffeur memorized the lecture and he once said, "Would you mind, Professor Planck, because it's so boring sticking to the same routine day in and day out, am I okay to give the lecture on your behalf? And you can sit and listen to my lecture." Professor Planck said, "Why not?" And the chauffeur gave this long lecture on quantum mechanics. After this, a physics professor stood up and he asked a very difficult question. The speaker said, "Well, I'm surprised in a city like Munich, I get such an elementary question. I'm going to ask my chauffeur to answer this question." It's a funny story. Whether it's true or not, I don't know. I have taken this story from a book named Poor Charlie's Almanack, The Wheat and Wisdom of Charles T. Munger. Also, there is a deeper point here than just the wheat and presence of mind of the chauffeur. In this world, we have two kinds of knowledge. One is the Planck knowledge, that is the people who really know the subject and they are master of their art. And then we have got the chauffeur knowledge. They have learned the talk. I think we doctors should have at least the chauffeur knowledge about financial planning. This is why I am making this video today. In investing, all of us start with a chauffeur knowledge. Some of us are lucky enough to gain experience and more mastery of this topic and they can upgrade to Planck knowledge. When we first start investing, we observe people, we learn from other people, we read, we watch YouTube videos, and we try to mimic what other people or more experienced people are advising us to do. It works for a while but may not work successfully in the long run. When I was an intern, that was the first time I started earning a monthly salary. It was not a lot, but at that point in time, I had no idea what to do with this money. First few months, I spent my money on buying gifts, clothes and other luxury items. If you are in a similar stage in your career, then the first lesson for financial planning for you is pay yourself first. You should spend what is left after savings and not save what is left after spending. This is a personal finance strategy of increased and consistent savings and investment while also promoting frugality in your day-to-day life. Of course, it depends on your personal circumstances, and once you have developed the habit of regular savings, then comes the next lesson. Lesson number 2. If you don't find a way to make money while you sleep, then you will have to work until you die. This is a paraphrase of a very famous quote on similar lines from Warren Buffett. But how do you earn money while you sleep? This is called passive income, or in my case, it was income from investing. I used to invest in stocks and shares. You might think, what's the point of investing my money if I can only keep the money in my bank account and earn an interest from it? My money will be protected and I'm going to get some interest on top of it as well. No, my friend, if you do this, you are going to lose your money because of something called inflation. Now, what is inflation? Inflation is a rate of increase in prices over a given period of time. 100 rupees today will not worth 100 rupees in 10 years time. The purchasing capability of 100 rupees is going to go down, and this is because of inflation. Inflation is typically a broad measure such as an overall increase in prices or increase in the cost of living. in a country. In India, it's approximately around 4 to 5%. The best recommendation is to only keep enough money in your bank account to cover your 3 to 6 months of expenses, and this is called an emergency fund. Any money that you are able to save above and beyond your emergency savings should be invested in some form or another. Now, how can you invest your money? There are quite a few options. One is equity or share market. Then comes bonds, property, or some miscellaneous investment avenues like Bitcoin or cryptocurrency, precious metals like gold. Equities are one of the most well known investment avenues, and you can invest in equities by either actively, that means you are actively making decisions or buying and selling the stocks, or it could be passive, which means you are only following the index of a market. I'll give you an example. In India, Sensex consists of 30 major companies of the Indian economy. If you just want to track the Sensex and an index of these 30 companies and invest your money on these 30 companies, then this is called passive investing, and the way you do that is called ETF or exchange traded funds. You can invest in the index for all countries like India, UK, US, and any other country of the world. So this is a very passive form of investing where you are not really buying and selling each and every company, rather you are just following the main index of that country. The other option is you can actively buy and sell shares of each and every company which you feel as an investor is worth investing. If you don't have the expertise of doing this kind of active decisions, then you can invest through mutual funds. In mutual fund, you have a manager who is an expert in his field who will make decision on your behalf and invest your money in specific companies. This, in my opinion, is a good way to start investing. Equity investments are long-term investment for minimum of 5 years, and if you could continue to stay invested for 5 years or beyond, then the chances of you losing your money is quite low. But there is a certain risk associated, and theoretically you could lose your money. The possible reasons why people don't invest in the equity or stocks are either lack of knowledge, or they're worried about fraud or scandals, or they don't have the risk appetite to stay invested. If you don't want to invest and you are not comfortable with the risk of equity investment, in that case the options are buying bonds. The bonds could be from government or from a corporate entity, and they work similar to fixed deposit. You pay some money to the government or the corporate entity and you earn interest because of the debt. The next investment avenue could be investing in property. These are high risk, high value investment, and if you can do that, there is a prospect of earning a lot of money, but there is also a prospect of losing all your money because it is dependent on a lot of factors. Now, to start investing in equity or in bonds, you will need a platform, which nowadays are mainly online platforms like Grow, ET Money, MyCams, KFinCart, where you have to open an account, you need to submit some documents, and then you can start investing by just the click of a mouse. I started investing during my MD when I used to get a regular stipend from 2011, and I have continued investing during my tenure while I was in India till 2015. After 2015, I have not been earning any Indian income, so I have not put a lot of money in my funds, but I have kept my money in the Indian markets. Now this is the snapshot of my mutual fund portfolio, and you can see the 4 constituent funds and the annual return of these funds. The combined annual return is around 46.4% as of today in last 12 months. This kind of return can be generated because of something called the magic of compounding. The magic of compounding. What it means is when you invest 100 rupees and after 1 year that becomes 110 rupees. Then from second year onwards you will be receiving an interest on the 110 rupees rather than on 100 rupees, which means the returns on investment themselves become part of the investment and they start generating returns. So if you stay invested for a long term, then after 5 years or 10 years, you are going to gain a lot of money just because of time in the market. We go to medical school to learn how to work hard for money, but you also need to know how to make money work hard for you. This is one of the most important lessons I wish I had learned in my school or in my college. Academic qualifications are important, so is financial education. They are both important for you to achieve your financial independence, a concept called financial independence and retire early. Let me know your thoughts on investing as a junior doctor in India in the comment section below. Stay safe and look after yourself. Please don't forget to like this video and subscribe to this channel and share it amongst your friends. Thank you.